Welcome back to Investing Talk Podcast.
Today we're looking at Cipher mining.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, so let's get into it. This is a really fascinating story.
It is. We're looking at a company that, most people knew as just a Bitcoin miner.
Right, pure and simple.
But something fundamental is shifting, and it's happening really, really fast.
Yeah.
They're moving into the world of AI infrastructure.
Exactly. And the Q3 2025 results are kind of the big flashing sign that this transition is in high gear. When you look at Cipher, the first thing that jumps out is just the sheer velocity.
Okay, let's break down those Q3 numbers because the jump was historic. Revenue hit $72 million for the quarter.
72 million, which is a massive, 65% increase just from Q2?
From $44 million in Q2. I mean, that's the kind of quarter-over-quarter growth you only see when a company is really hitting its stride.
And that's what happened. That surge was driven by two things. Yes, the Bitcoin price helped, but the real engine here was operational.
More production.
A lot more. They mined 629 Bitcoin in Q3. That's a huge leap from, I think it was 434 in Q2. They're just running their facilities at peak efficiency now.
But here's the part that I think might confuse people, that paradox in the financials.
Yeah.
You see this amazing growth. You see Q3 earnings per share at 10 cents, which is up 34%. And yet, the company reported a net loss of $3 million.
Right. And that's where you have to understand what an infrastructure business looks like when it's in high growth mode.
It's like a construction company or something.
Exactly. That GAAP net loss. It's almost entirely driven by depreciation expenses. It's a paper loss.
So they're spending billions on new servers, new data centers.
Brand new, high-value assets. And under GAAP rules, you have to start depreciating those immediately. So the company isn't actually bleeding cash on its operations.
They're just investing so aggressively that the accounting creates this temporary loss on paper?
Precisely. They are sacrificing a little current paper profit for massive structural scale. And that scale is the key to the most important part of this whole story.
The strategic pivot.
The pivot. From a volatile Bitcoin miner to a stable high-performance computing or HPC infrastructure provider.
And this isn't just like a side project. The partnerships they're signing they're enormous.
The deals are huge, and they completely de-risk the future. The biggest one is that 10-year colocation deal with FluidStack.
A deal that could be worth up to $9 billion.
$9 billion, with an initial commitment that's already around $3 billion. Plus, they've got deals with Amazon Web Services, with the Google and FluidStack network.
That FluidStack deal alone feels like an escape from that crypto volatility cycle.
It is the defining move. Bitcoin mining revenue goes up and down with the token price.
Of course.
But HPC contracts, those are guaranteed long-term, almost utility-style revenue streams. That fundamentally changes the entire investment profile of the company.
And the forecasts really show that. What does that revenue mix look like in a few years?
It's a total flip. By 2027, the projections show HPC revenue could scale to almost $740 million.
Yeah, and Bitcoin mining.
Just under $200 million. So they're aiming to slash their exposure to Bitcoin volatility by, almost 80% of their revenue stack?
An 80% reduction in their biggest systemic risk. But, building out that kind of HPC infrastructure, that takes an astronomical amount of money. How are they funding this?
They've been very, very smart in the capital markets. They just did a huge capital raise.
Your convertible offering, right?
A $1.3 billion convertible offering, and on top of that, a $1.4 billion private offering of senior secured notes.
So let's quickly unpack that for a second. The senior secured notes, that means they locked in a fixed interest rate, right?
Very manageable, 7.125%. So they've locked in their borrowing costs now to build the assets that are going to generate high margin revenue for the next 10 years. It's a great move for stability.
And all of this money is being funneled into one primary project.
Pretty much. It's all about the Barber Lake HPC data center near Colorado City, Texas. That facility is the engine for this entire pivot.
Which brings up the question of their competitive advantage, their moat. I mean, this is a crowded space.
It is, but their edge isn't software. It's infrastructure, scale, and cost. They have one of the largest power pipelines in the entire industry.
I saw that number. It's staggering.
3.8 gigawatts of power across Texas.
Just to put that in perspective, that's enough to power a small city.
It is. And that scale means they can get power cheaper than anyone else. It allows them to offer incredibly competitive hosting prices to the hyperscalers, the Amazons, the Googles. who need massive, consistent, cheap power.
But having the power and the money is one thing. Execution is another. Can they actually build this stuff?
Well, that's where their track record comes in. They've already delivered 5 data centers.
On time and on budget.
On time and on budget. That's the kind of reliability that these big partners demand. It gives you confidence that Barber Lake won't get bogged down in delays.
Okay, so let's talk about the financial metrics right now. Because if you're a traditional investor and you look at the numbers today, they can look a little scary.
They can. A price-to-sales ratio of over 56. A negative EBIT margin of what, negative 98%?
Right. Those numbers would normally scream, run away.
And they would if you were valuing it as a simple mining company. But the market isn't. The market is pricing in the future.
They're pricing in that nearly $750 million in stable HPC revenue that's coming by 2027.
Exactly. That high PS ratio is basically the cost of admission to the AI infrastructure club. Everyone knows the negative margins are just the cost of this massive expansion.
And they have a buffer. Their treasury holds about 1,500 Bitcoins.
Which is a nice liquid war chest they can tap for immediate needs without having to dilute shareholders constantly. It's a smart self-funding mechanism.
Okay, let's shift to market momentum. A pivot this big, you'd expect to see it on the stock chart.
Oh, you are. The stock has been volatile, but the direction is clearly bullish. We saw that huge 44% rally.
And that 23% jump in pre-market after the Q3 earnings?
Right. And even with some profit-taking, the overall structure is strong. It keeps making higher lows and higher highs.
A classic uptrend. It's trading above its 50-day and 200-day moving averages.
Precisely. Support seems solid around $18, and it just broke through that key psychological resistance at 23. The momentum is building.
And when you see that kind of move, the big money tends to take notice. Are the institutions buying into this story?
They are buying in big time. We're seeing what's called cluster buying activity, which means high conviction. This isn't just retail enthusiasm.
Any big names?
Oh, yeah. Soros Fund Management, for example, increased its stake by over 67%. They hold 1.3 million shares now. You got Rumline, 2Cs, all reporting new or increased stakes.
A vote of confidence from someone like Soros Fund Management is, well, it's a big deal.
It is.
Which means we should also talk about the insider activity, because we have seen some selling from management this year.
Right. And it's important to look at that impartially. There was no insider buying reported in 2025, but the selling we saw, it needs context.
Like the CEO selling over 700,000 shares.
Yes, but that was settling performance stock units. And another officer sold shares under what's called a Rule 10b5-1 plan.
Which is a pre-scheduled plan, right, to avoid any hint of insider trading.
Exactly. It's a prearranged plan for liquidity. They set these things up months in advance. So given the massive institutional buying we just talked about, this kind of pre-scheduled selling it's really seen by the market as a neutral event.
Okay, so that brings us to what's coming up. If you're watching this story, what are the near-term catalysts to keep an eye on over the next, say, 3 months?
There are a few key dates. First, keep an eye out for the Q4 preliminary earnings guidance. That should be around February 2026.
And that will be our first real look at how this HPC ramp-up is starting.
Exactly. Then you have the more mechanical market events, the ETF index rebalancing on December 31st.
And the institutional fund rotations right at the start of a year, around January 2nd.
Right. And there's also a warrant redemption deadline on December 26th, which is just a small thing that helps clean up their capital structure.
What about the chatter? What are the whispers about potential upside?
Well, there's definitely speculation building around Barber Lake. The rumors are that the build-out might actually beat their initial guidance.
Which would be a huge upside surprise.
A huge surprise. And, you should always be watching for new partnership announcements that could complement that big fluid stack deal.
So zooming out again, what are the big long-term tailwinds here?
The long-term case is just so compelling. You've got potential M&A in the sector, their potential to expand into new regions, and just the massive macroeconomic trend of AI.
The global demand for computing power is just exploding.
It's growing exponentially, and Cipher is building the physical foundation to capture a piece of that.
So let's just circle back and summarize the risks one last time.
Okay. Risk number one is still Bitcoin price volatility. It's always there.
But that's what the pivot is designed to fix.
It's the whole point. That diversification into stable, contracted HPC revenue is their structural hedge against the crypto winter. It should offset up to 80% of that risk by 2027.
And the other risk, the high spending, the negative margins.
That's essentially priced in. It's the necessary cost to scale up and enter this incredibly profitable HPC segment. The market gets it.
So this company really presents a fascinating dual opportunity for you. You have these short-term catalysts over the next quarter, the earnings, the rebalancing. But the really compelling story is this multi-year transformation.
It is. The move from a pure Bitcoin miner to a diversified AI infrastructure provider with a 3.8 gigawatt power pipeline. It's a fundamental shift in the business model. So the key question you need to ask yourself is, how quickly can they execute the Barter Lake build-out to get that stable, high-margin HPC revenue online?
That execution speed is everything.
It's everything, and that's what we'll all be watching.
That's our analysis for today. Make sure you hit that subscribe button to catch our next look into the market.